Hi guys, this is Josh and welcome to another episode of Fundamental Finance and Investing. Today I thought it would be cool to discuss other strategies of investing other than value investing because as we know, value investing can be quite time consuming sometimes when you are putting a whole lot of research into a specific company or the industry that the company operates in before you actually buy the company. So for people who may be like time poor or they just don't want to put that time in because they have other things that they can be doing, what is another strategy that we could use? And my ideal strategy other than value investing would be to buy index funds or exchange traded funds. Basically, you're buying an index such as the S&P 500 or the ASX 200. And by doing that, you're getting a share across all of the companies and you're very diversified across the whole index if you buy an ETF, depending on what ETF you do buy, because there are so many that you can choose from these days. One thing I like about buying index funds is that you're saving on fees. So if you were to, go with a financial professional to invest for you, you're actually paying, fees upwards of 1, 2, sometimes even 3%. And those fees over the long term really hurt your gains. They really affect your outcome at the end of, say, when you're ready to retire or something like that. So buying an index fund, you're paying fees as low as 0.15%, and you're usually getting very similar, if not better returns than some financial professionals. And that's not to say that financial professionals don't have their place in the financial world. They do. They offer great services. And, for people who are, have a lot of capital and are quite time poor, they're the perfect way to go for investing and protecting your capital. So how do you buy index funds or ETFs? So pretty much on your brokerage platforms, you can search for ETFs. My favorites would be something like a Vanguard or an iShares. And you can simply just search Vanguard and you will come up with a number of ETFs that you can actually buy. So, for myself in the past, I've bought VAS, which is the Vanguard Australian shares. You can also buy VGS, which is Vanguard International shares. So there's so many ETFs that you can buy. And if you're somebody who doesn't want to own particular companies, there's also ETFs based around sustainable living, sustainable energy. There's just everything that you can buy now, and I really highly suggest that you go out and look at ones that you want to buy, check out the previous track records of them, and see if it's something that you want to invest in. But as a strategy and as a plan for buying, I really reckon dollar cost averaging is a great idea, and all that means is that whether you have $1,000 now and you invest that $1,000 into an index fund or an ETF, and then say every time you save up another $1,000, you invest again, and then save up another $1,000 and invest again. That's one way of doing it. And basically what you're doing is every time you have the $1,000 you're investing, regardless of the price, because at the end of the day, if the price goes up, you're getting less shares. But if the price drops, and say we do have a financial crisis again, and the price drops heavily, you're actually, putting the same amount of money in again, which means you're actually getting more shares. And that way, if you're getting more as it gets lower, when it grows again, that's going to be able to compound your wealth very quickly. But the whole point of the dollar cost averaging is that you're buying shares regardless of the price the whole way through, and then you're kind of averaging out your returns, when they're great or when they're bad. And, typically over a long period of time, you're actually going to do better than if you just put money in and then leave it there. Another plan with a dollar cost averaging could be that depending how much money you save of your income and you put aside for investing, you could invest that money every month. You could invest the money every quarter. You could invest the money every 6 months. Whatever works for you and your financial situation. That's probably one of the most simple ways to be invested in the market, be continually invested for the long term, and then really allow the wonders of compounding to do the great effects to your wealth over the long period. Once you hit that 20 year mark and you've been invested for 20 years, you're going to see some very exponential gains by that point. So yeah, if that would be my, if I wasn't going to put in the time and effort into researching companies, that would be my That would be my strategy moving forward. I do that for myself on the side as well, just to be, not diversified, but with my family, we get to invest together and practice that together. So that's one thing we do with, say, like 10% of savings of our money, and then I invest my strategy personally for our wealth as well. So I guess you could say that I'm diversified a little bit there as well, but it's a good way to, get the family involved and teach how to invest for the long term. And it's a great way for people who don't want to put the time and effort into researching companies, or people who are just time poor in general. So that was my thoughts on strategies around value investing, fundamental investing. If you got any value from this video, feel free to subscribe and hit the like button. And I will see you in future videos. Thanks for watching, guys.